What I'd like to do is run each item and have the staff presentations and consultants' comments for each item, then followed by questions and answers, and where appropriate, an action after the presentations. So if you could please keep your questions and make notes of your questions that you would like to ask, I think that process lends itself to a more efficient meeting. Okay. Just want to make the following announcement for the public relative to public comments, that the board will have 10 minutes of public comment period at the end of each agenda item. Public comments after each item is limited to the agenda item that is on the topic. There will be an additional opportunity for statements from the public for items not pertaining to a specific agenda item, and that is at the end of open session. Individuals wishing to speak to the board should complete and submit a speaker request form and submit that to our CEO or another CalSTRS staff. You'll be allowed a maximum of 3 minutes for your comments. If there is not enough time for the speakers to have 3 minutes, the timing will be at the discretion of the chair. Our meetings are live streamed on the web and video archived, which are available to the public at calstrs.com. An issue we take very seriously is to protect the privacy of minors who wish to address the committee and board. And in that spirit, public comments made by members of the public who are under 18 may address the board, but CalSTRS will not live stream or video archive these comments. Public comments for those in the room that are 18 will be recorded and included in the streaming of this meeting. Members of the public may speak to the board during their allotted time, but audio and visual recordings from a third party are not allowed due to copyright issues. With that, I will entertain a motion to approve the agenda for the day. It's been moved. Is there a second? It's moved and properly seconded. Without objection, the agenda has been approved. Item 2 is the consent item, the approval of the minutes, and I know that Karen Yamamoto has an amendment to the minutes. So Karen, let me get to you now. Karen.
Okay. Hi, thank you. Just some edits, quick edits. Page 7, or INV 7 at the top in the first paragraph, second to the last line, Ellen Emkin, E-M-K-I-N. And then Roman 4.
Leave it to a teacher.
Now, these minutes are going to be in posterity, right? So we want to make sure that they're right. Okay, Roman 4, third line from the bottom, low dash carbon. Under public comment, the first paragraph, second line, Ms. Fosberg, F-O-S-B-U-R-G. And then Roman 5, the title, semi-dash annual. And then on page INV 9, Roman 8, first paragraph, last line. I'm not sure what that's, should it be indications that the bull market and it be stricken, deleted, delete the word it?
Okay, got that?
Okay, got that?
Yep.
And I think that's it. Thank you.
Thank you, Karen. So with those amendments, any other committee members with changes? Seeing none, I'll entertain a motion to approve it's on consent. All those in favor of approving the minutes as amended by Ms. Yamamoto, say aye.
Aye.
Opposed? Okay, the minutes have been amended. Thank you, Karen, for your great modeling. So if we could all try to remember to reference when we're referencing the materials, if we can reference the page number for us, to help our colleagues to also look along as we're commenting on an item, that would be very, very helpful. Not only did you comment on the page, the paragraph, and the line. It's very helpful. Thank you, Karen.
She's an educator.
Dana?
As Karen was going through the minutes, I took a look at the persons that were present. And Ms. Fosberg is not listed as present, so I would like to remind the public that if you are in the overflow room, to make sure that they sign in, that they're here, so we can capture who all's here. And if you come late to the meeting, hopefully, if someone can remind them also to sign in, so we can really capture who all we have in attendance, it would be really helpful. Thank you.
Thank you, Karen. Dana, thank you. So our major item of the day is this action item, the 2019 Asset Liability Study. And I'll ask staff to come on up. Josh Diedish, Geraldine Jimenez. So
Wow, sound music. That's new.
this,
We're not going on yet, though. If we can have silence in the room so we can present, we would appreciate it.
so
Mr. Chair, do
okay,
you want to?
we're gonna.
Have a motion, please.
Yes,
Have a motion to reconsider the agenda.
and there's a motion to reconsider the agenda. Is there a second?
Second.
Okay, there's a second to reconsider. Do you want to speak to your motion, Dana?
No.
Okay, so the motion on the floor is to reconsider the agenda to, for the chair to have flexibility.
Just to reconsider.
And to reconsider. So we'll just vote on the reconsideration.
I did vote on the prevailing side.
Oh, you did vote on the prevailing side, thank you. All those in favor of reconsidering the agenda, say aye.
Aye.
Opposed? We will reconsider the agenda. Dana?
I'd like to move the agenda with flexibility, please.
Dana's motion is to move the agenda with flexibility. Is there a second?
Second.
Okay, it's moved and properly seconded to approve the agenda with flexibility. Seeing that Ms. Dillon does not want to speak to her motion, all those in favor of approving the agenda with flexibility say aye.
Aye.
Opposed? Thank you. The agenda has been approved with flexibility, which brings us to item 3. And just for housekeeping purposes, we will hear the asset liability study momentarily. After the asset liability study, we have members of the public, and we will hear from members of the public that are here. Each member of the public will have 3 minutes to speak to us. So that will come immediately after the asset liability study. And I think Chris has informed the staff of what's appropriate at that time. So we'll turn it over to Geraldine. This is our action item for the day. Ms. Jimenez?
Good afternoon, Geraldine Jimenez, Director of Investment Strategy and Risk. We're here with the final step in the asset liability study. We've come back all year. We're recommending an asset allocation. As you can see, it's November. If you approve today, we'll be back in January with actual policy change. What's important too is look at the liability line. The actuaries are reporting this meeting or this board meeting on the funding levels, and what you adopt today will inform the adoption of the actuarial assumptions in January. Our follow-up from the September meeting was 2 important questions that the board directed us to come back with. Here you see it, it's pacing and the private assets. And so we're gonna have the consultants give their opinions, and they're gonna walk through the pacing in just a minute. And then we were also asked to look at private equity allocation of 10%, and we'll also touch upon that today. This is just to remind you what we did recommend. It's still there, the recommended allocation. We discussed another portfolio lower allocation. You'll see our current long-term targets, and then you'll see the 10% to private equity. Josh Diedish here, our risk portfolio manager, is going to talk a little bit about the 10% to private equity.
Great, thank you. So we looked at this alternative, and then just like 2 minutes to talk about this, and then we have I think John up next to talk about private equity pacing. So one of the questions was basically, what does it mean if we were to lower from 13% to 10%, the target allocation to private equity. There's a couple of natural ways to look at it. One is to lower private equity by 3 and just simply increase global equity by 3. It would be sort of the closest thing we could do to maintain the same weighting to economic growth risk. Basically, the implication of that, because we expect to earn higher rate of return from private equity, is that the portfolio expected return would go down by about 10 basis points. And so whenever we look at kind of small to moderate shifts like this in the allocation, the high level numbers, the average numbers that we see in terms of return and risk can look pretty small. So another way to look at it is, if we were to actually maintain that same expected rate of return, what would we have to do with the asset allocation? And so because of the higher rate of return we get from private equity, if we lowered by 3, it wouldn't be enough to just increase global equity by 3. We would actually need to make an additional change and lower fixed income by 2, and then increase global equity by 5. And that would allow us to maintain the same level of expected return. It'd be a little bit higher risk, but to me that, and I think to us as a group, that's a more meaningful shift and kind of an interesting way to look at this, that, you know, it kind of highlights the value that we expect to get from private equity. The higher rate of return allows us to basically have a little bit more diversification in the portfolio. And that's kind of the gist of why, you know, given that we're comfortable with our ability to earn the rate of return in private equity and our ability to get there on the allocation, that, you know, we're sticking with that 13% recommendation to private equity. So I think that was it there, and I think John's going to start on the private equity pacing.
Great. We have an exhibit which you can present.
Go through. Yeah, I think if you click through.
John Haggerty, Makita Investment Group.
You should be able to click through. It should go to.
Okay.
Nope.
So there's a second PowerPoint you were going to pull up?
Great, thank you.
This is the inflation sensitive.
So,
That's okay.
It's okay, we'll start with that.
okay.
So we're taking them in a different order. We'll do inflation sensitive and private equity, but John's going to do both.
Great. So just as a reminder, we were asked to more or less look at the feasibility of executing. And the bottom line is that with both private equity and inflation sensitive, it seems quite feasible to execute. In the case of private equity, we examined both the 13% and the 10%. And we show some detailed implications for the deployment of assets, which is the critical output. And the summary for private equity is that at the higher level of 13%, the team is currently executing at that rate. And with an examination of recent deal flow for the team, they're right on the $7 to $8 billion deployment to achieve that target. It does go up with time, and I'll show you some of the examples of that. The inflation sensitive is quite different because you're dealing with many components that are open-ended. And so you have the ability in the TIPS portfolio and in the agriculture and the small portion of that's allocated there to add and subtract as you will, because you have open-ended vehicles. So here's the executive summary for the inflation sensitive part. Again, we independently modeled this, and it is clearly feasible to achieve the long-term target of 6% and the short-term target of 3%. We did our independent modeling, but also work with the staff on the assumptions. So this is a collaborative effort. And here is the overview of it. Infrastructure, as a reminder, you're using both closed-end funds and what we call perpetual or open-ended funds to which you can add and subtract capital over time. And in the center, you see commodities and TIPS. Both of those are accessed through the public market, so you can reduce your exposure to zero and double it as you see fit very easily. And then lastly, farmland and timber, which I made reference to earlier, uses a combination of funds that we need to model because they're closed end and also perpetual. So here's the output of it. The key takeaway is the volume of deployment You see the perpetual commitments in the lighter blue, which is a smaller portion of it, and then the non-perpetual, which would be the closed-end funds, which you need the complex modeling for, is at a level of 750, very manageable, and rising to about $1 billion in 2030. So our conclusion is quite simple, that it's quite feasible to achieve. And here's the other component of it, which is quite small. It's a fraction of a percent that's allocated to farmland and timber. And if we could see the one for private equity, okay, great. So this follows very much the same format. I have okay, there we are. Excuse me, a little bit of a lag here. So I have cut to the chase already. Again, we've looked at both 13 and 10%. There's some slightly different implications for if you were to stop at 10%, you'd overshoot just a little bit because you're already at 9. You have a lot of dry powder at work or available within the private equity portfolio. And these details are shown here, where we're optimizing towards a 13% allocation with private equity over the long term. And here we show this being achieved in the 2020 to 2023 timeframe. And the current pace that we show for, which would be for this year and 2020 and 2021, is about $7 to $8 billion. That's roughly about where you're going to end up for the calendar year 2019. So quite achievable in our view, especially as you add resources to work in the realm of co-investments, and that will rise to a level of 9 to 12 billion in later years. This shows what you would need to do for the 10% target. That would involve a reduction of roughly $2 billion in your deployment, and the rise in later years to sort of stay at the 10% would be smaller and more along the lines of what you're deploying today. You would reach 10% potentially next year or the year after that. This last slide is a little different. It provides a bit of peer context to the 13% allocation. And what we show with the investor force data that we looked at for groups with 10 billion portfolios and above is that your exposure is right at the average. It was coincidentally about 12.5% compared to your 13%. But I will mention that the range is quite large. And there are some peers of yours in the U.S. public pension fund arena that have as little as 6% and some that have in excess of 22%. So that is simply an average of that universe of roughly nine funds that we looked at. And that's that. Thank you.
Thank you. And then we're going to have Ben Mazatlan from RCLCO talk about the real estate pacing.
Hi, Ben Maslin from RCLCO. For context, we were also asked to opine on the feasibility of real estate being able to achieve a 15% allocation. And so, just to provide additional context, the portfolio today is at about 14%. So to get to a 15% allocation would be about an increase of about $3 billion, which is about half of what the increase in real estate has been over the past 2 years. So staff has demonstrated an ability, in other words, to allocate additional capital to the space. And they've done it in an accretive manner. And the chart on the right-hand side illustrates the total returns, the net returns, that CalSTRS has achieved versus the benchmark, the Odyssey index. And so the basically looking at historical performance, staff has been able to meet that mandate of increasing capital there. How they could do it? So if today the portfolio is about 14%, which is above where the current target is, below where the long-term target is, but there are multiple options to get to the long-term target. The portfolio has been net sellers. So on the left-hand side, you can see disposition activity year to date. But the options could include slowing down disposition activity. There's a number of debt maturities coming up within the near term. Options can include decreasing leverage, or there are other tactical options such as increasing allocations to liquid securities like REITs. In terms of the context, though, of the overall environment, we're approaching an environment where we're in a high-priced environment, and the market is expecting lower go-forward returns. And so an appropriate pacing is necessary, which I think Geraldine will get to in a moment. But CalSTRS is well positioned in that the vast majority of unfunded commitments within the real estate portfolio are within their control, so within collaborative model investments. And so there is no urgency, number one, to allocate capital. Number two, staff controls the ability to allocate capital in the space and in an effective manner.
Okay, and then we have a summary slide. So as a reminder, so basically we had two questions to answer for your discussion. Is 10% private equity make sense? We tried to address that. We also tried to address your pacing question and independent views from the consultants. This is the recommended asset allocation. In a summary, it's basically we believe it's better diversified and meets the needs of our funding plan while it takes advantage of our collaborative model and is focusing on drawdown. We're increasing risk mitigating strategies and adding real assets, which provides income streams, which also help during a market drawdown. At this point, I wanted to turn it over to Christopher Ehlman and Scott Chan briefly as the senior investment teams to opine, since this is our recommendation.
You go first.
All right. Great. Well, first of all, I think the staff has done a fantastic job here over 6 steps, and I'm most proud of the process that we've gone through between the board and the staff, in the sense that there's been really robust discussions between Makita, RCLCO, and staff. All of our asset classes, of course, have gotten involved to look at the projections, and from a board level, we've gone through those 6 steps. I think there's been great questions. And above that, we've gone through a lot of scenarios, 10% private equity, 13% private equity, and the scenarios between the 6.5% to 7.2% that we did a few board meetings ago. So emphasizing the process, I'm really glad that we've gone through this process. And I think we've come to a decision today where both Makita, RCLCO, and staff really are unified in this asset allocation, and it's something that we very much back.
Chris Ehlman, Chief Investment Officer. We've done a lot of asset allocation studies over the years. I think this one is very helpful, and I recommend this asset mix. It will take us time to get there. We are going to incorporate climate change and adapting to it throughout every asset class in this policy. And I leave it up to you to have questions, but the staff and the consultants recommend your approval.
Stephen, before we turn it over to questions from the committee, anything that you want to add commentary on, in particular around the movement around public equities?
Sure. I mean, I'll just without kind of echoing thoughts of others, reiterate Makita's recommendation for the asset allocation. The significant changes, as we discussed at the last meeting, are a reduction in the global equity allocation and a corresponding increase in real asset and inflation sensitive, as Geraldine sort of highlighted in her summary. So we think this is a strong asset allocation. It reflects a nice balance of considerations and risk and expected returns with the portfolio.
Thanks. So we'll turn it over to questions or comments from the committee. Just as an FYI, the write-up speaks about what the next steps would be should we adopt this recommendation. Staff would come back to us with their plans for implementation at upcoming meetings. Sharon?
Yeah, thanks, Harry. So I just had a question. I know we have the big cost report later, and you know how mindful we are of costs, and I'm sure, Ben, you've addressed this in your real estate comments, but I guess I'd love to just get a general sense of, you know, when we think about how expensive real estate is, and then we're looking at upping our allocation and then upping our allocation in real assets, which tend to be pricier than global equity. And so I just wondered if you could comment a little bit about cost and sort of how are we thinking about, in my mind, I would say, well, costs will increase if we're, moving to a higher allocation of higher costs in the private market. So could you just talk a little bit about, just in general, the costs and how we're mitigating that moving forward?
Yeah, so Sharon, that's a great question, because as we push more into the private market and lower our equity allocation, it's just going to lead to overall greater costs and fees. But as we've analyzed each of these asset classes, we've done it on a net return basis, including all of the costs. And so what we're thinking is that the net return for the risks that we're taking is going to be greater and more optimal with this portfolio. We do care a lot about those costs, not only the costs, but the way we structure the return opportunities, the way we control the risks, and the fees. And that's where we've been communicating the CalSTRS collaborative model to you, that in these private market assets, we're really going to forge a different path going forward. And in the cost report, what you've seen in the materials is that we're starting to then account for that. I think Deborah and her team have done a really good job. You'll see in that hybrid section of how differentiated it is when we get into joint ventures or SMAs or owning partial or full interest in companies, how the costs go down for us in these private markets. You're spot on, the costs will go up, but again, we're net return investors, and so we're looking at the net return total of CalSTRS, and this is a way for us to generate a better return on risk dynamic.
Got it.
Thanks, Scott. Thank you, Sharon.
Thanks.
Next is Gail Millett, Department of Finance. Gail.
Thank you very much, and just a huge shout out to the CalSTRS staff, both in terms of changing the constraints and all the work that went into that. And I do think it's really illustrative that every time we change something, it's not just a simple subtraction problem. So I really appreciate that, and especially to Josh, who reran the model. So thank you very much. Just, Mr. Chair, 4 quick questions, I hope. The first one on private equity, I appreciate the pacing. I do think sometimes the question is less around pacing and more around strategy. So I just want to make sure the overarching strategy around partnerships versus co-investment and how much co-investment you think we can do as a piece of the whole pie. And then how long you think it'll take to create a co-investment team here at CalSTRS?
Great question, Gail. Thanks for the question. Currently, our co-investment base is around 10% of the allocation today, and we're hoping that we can double that to 20% over the next, call it, 5 years. The first step of that, for us, in terms of trying to increase our co-investments, will be to build a co-investment team. And so Margot, the director of private equity, and I have been really working on that plan. So we've got roughly 4 key hires that we're looking at over the next, call it, 6 months. And why that's important is because the co-investments is a bit different in terms of the transactional analysis than the GP analysis, right? So we're looking at portfolio companies, what makes a great company, and how do we select that? Versus on the GP side, we're just saying who's a great partner for us and who can generate returns. It's also different from a transactional perspective in the sense that in a co-investment, you're going to need to respond within a certain time period. GP investments tend to be planned and sprinkled through the year. What funds are looking to fundraise? And so it's sort of a completely different way to think about operating the team structure. So that's, in short, we're building a co-investment team. And if we were to look far in the future, I think over the last 5, 6, 7 years, it's been a little bit easier in an upcycle to make co-investments. The performance, certainly in our portfolio, shows that from a co-investment perspective. But as we go forward, it's going to become more difficult to select the right co-investments in the right portfolio companies. So again, it goes down to expertise in the staffing, and we want to build that co-investment team. Now, I don't want to shortchange the staff because we have been doing co-investing for a long period of time, so they have a significant experience. But as we think about ramping it up, doubling our amount, and thinking about a more difficult selection process period as we look forward in the future, then we need to build a different kind of skill set. I don't know if Margot wanted to. Okay.
I appreciate that. And then as we look at the long-term, we've spoken a lot about kind of the dry powder, the investment opportunities available that have been committed versus the returns we're getting in private equity over the long term. This is less of a question, but more of on a looking forward basis, as we implement the strategy fully, if we could really start, to Mr. Emkin's point, looking at that net number. So, how much is coming in and going out over the long term, Mr. Chair, if that, certainly nothing immediate, but just as we go forward, I think that's an important data point.
Chris Allen, Chief Investment Officer, that's actually in your semi-annual report that Makita presents to you, and we can pull that out and make sure that's a more regularly reported number, say quarterly to you, so you know the net distributions, commitments, what's drawn down.
Great, thank you. And then, Mr. Chair, just a couple more.
Right ahead.
On the real estate asset allocation, I noticed there's a big increase in investments in REITs. Obviously, they've had, good and bad, and just a little bit around the strategy for that. And Ben, I don't know, I know you looked into that. If you just have any additional.
Sure, there's a total commitment of $500 million, but really an initial investment of $100 million, which is just a fraction of the overall portfolio. And so the strategy is effectively a relative value strategy. So looking at discounts and pricing of the actual securities relative to the net asset value of the underlying real estate. I would characterize it as the tip of the spear into REITs, and that because it's such a small initial investment, that it's effectively a discovery phase in terms of whether or not this is a tactical asset class within real estate that's worth considering additional capital to.
Right. I'm just wondering, as we look at it and in the discovery phase, if there's anything specific around REITs and the risks inherent in a REIT that we'd want to be mindful of, or that you'll be looking at in particular?
They're professionally managed real estate operating companies, and so they have the same risks that you have within the private sector. They just have greater volatility because there's price discovery daily. But yes, there's additional, as a result of that, we'll be looking at the impact on the overall volatility of the portfolio.
I'll just add a small answer, and then Alan, you can go. REITs are correlated to stocks, so that's a concern that we always look at. What we're really looking at is when are they overpriced, when are they underpriced, and can we just add them, as Ben said, as a relative value. The risk also is the tax structure, and then the fact that lots of times their governance is pretty weak. So it is something we're doing with a grain of salt, but it's a liquid part of the real estate portfolio we think can add some value.
Thank you.
Alan and Makita, Chris raised the issue, but it's really important to underscore. Historically, REITs have been much more highly correlated to the public equity market than they have been to core real estate. And as such, they don't provide the diversification benefits that you would get from traditional core real estate. But as part of a real estate strategy, it makes enormous sense because sometimes there'll be much more value in the publicly traded aspects than privately, and this gives you the opportunity to be in that space.
Great, thank you. And then my final two questions are just around the innovation portfolio and the global equity. On the innovation portfolio, just any plans to look at that in terms of the sustainability and investment portfolio in addition to experimenting with portfolios. And then on global equity, just as we do have a higher percentage that's actively managed and hopefully actively managed in-house, if there are any kind of barriers to performance that you think that the board could help you achieve greater returns in global equity. And those are my final two questions, Mr. Chair.
Those are really great questions. So talking about an innovation portfolio for SIS, we previewed the idea of bringing forward an innovation portfolio for the Sustainable Investment and Stewardship Strategy Group around climate change, but also around ESG in particular. And so we're going to try to bring that forward. I'm going to guess that we'll start to talk about it in March at the board level. And right now, Geraldine is going to lead the way. She covers the current innovation portfolio and has some ideas to bring forward some policy changes in January. So we get a preview of what the SIS portfolio will likely look like along those lines as well. So that's definitely coming. Your second question was around June Kim's global equity portfolio. And I just want to mention that we've been going through a study of the risk budget for the total fund. June has been leading the effort because we think that her portfolio in particular would really benefit from a risk budget approach, because as we know now, the way it's structured by policy is that we have an active passive split by region. And I think June's been very articulate in saying how that can be a constraint for her. It's a constraint in the sense that she may want to launch risk factor strategies, maybe have global portfolio managers. And we talked about taking some of the emerging markets from active and possibly doing some passive, which would lead to some cost savings or fee savings in that event. So I think it's a very important initiative. And to your point, that portfolio is something where we want to likely lead and accelerate and do in a pilot program as a venue to move it to the total fund. And so we'll be looking to more and more engage with you regarding adopting a risk budget in the global equity portfolio.
Thank you very much.
Karen?
Oh, okay, thank you.
You're welcome.
You talked about the targets, and I've always been told that the asset allocation is the most important decision that we as a board make. But we talk about the target, but how about can you talk about the differences in risk between the recommended portfolio, the 10% in public equity, and the current portfolio?
Sure. So I think the way I would sum it up is that the portfolio we're recommending is a little bit better diversified. So compared to our current long-term targets, the risk level, the absolute risk level is a little bit lower. But because we're shifting away from global equity and into real assets, we get a little bit better diversification. And then it's kind of a similar story with the 10% to private equity. The portfolio that we're recommending relative to that allows us to keep a little bit more in diversifying and still maintain the same level of return. So kind of the short answer is that the risk level is basically a little bit better, both sort of on a quantitative way, but also sort of our professional judgment, a qualitative way, that it's just a little bit better diversified than the other two. That's how I would sum that up.
Okay.
Thanks, Karen. Josh, if I could just follow up on that. When you talk about increased diversification, is it appropriate then to think that when there's when the winds change, that it reduces the volatility potentially within the portfolio as well?
Definitely, and particularly with respect to the increase in both really RMS and real assets. And we designed RMS specifically for that type of circumstance. And then with real assets, because the return driver is more stable income, that when the winds do change, when we get the next equity drawdown, those assets should perform a little bit better, and they should perform a little bit better in sort of relative time against public equity too. And those two things are really what drives the improved diversification.
Dana?
Thank you, Eric. We've talked about this for a year, and so I need you to remind me how we think, and I know we have an item later on ESG integration, but how are we going to do the integration of ESG through the asset liability management?
ESG is integrated into every asset class you see up there. ESG is integrated into every investment policy. Clearly a focus for the board coming up is going to be that low carbon future. And that's going to be a part of every single asset class's discussion of what does that future look like? How should we anticipate it? What can we do? Because it's going to present risk and it's going to present opportunities. What can we do within each of those asset classes to adapt to it? So I want to emphasize this, as we heard at the offsite, climate change is in everything and everywhere. So we're not taking a single subject focus. We're actually spreading it across the entire portfolio. So it's in every asset class and part of every asset class. So it is not a separate asset class of just a side program. I want to emphasize that. It is part of what we're doing in every asset class.
Thank you, Chris. And then my last question, Harry. We've talked, Scott, about what we need to build the co-investment team. So it sounds like, and with the collaboration model, we know we need to have more investment staff, but I don't necessarily want to say, do we have the right people to implement the new allocation? What more, because our staff is amazing. So I think we have the right staff that we have now, but what will we need to build on besides private equity to be able to implement the new allocation target?
Chris Elman, I'll answer that. You have an amazing staff, but fact of life, they're all aging. And so we need succession, which we're building into every asset class. I have to say, we've really tapped into the Sacramento talent market extensively, and we can still pull a few rabbits out of the hat, but yeah, you have two big investment funds here in town and very few other financial institutions to provide us staffing. So we're realizing we have to look up and down the state. Part of that means that some of those people shockingly don't want to come to lovely Sacramento when they live near a coastline in California. I don't know that we have to go, we're going to reach that area first before we try and go across the country. Obviously, we've brought some people in. You can tell by the accents. We've been able to bring people from different parts of the land here. But that's a big part of what Scott and I are thinking about into the future, is not just the staffing you've given us this year and how we're going to ramp up with that, but where are these people located? How do we find that talent? We're going to be talking to the compensation committee. The whole board's going to have a presentation, I think it's Friday, from Luis Navas about the challenges with the collaborative model, that we need some additional skills that are frankly higher paying than some of the ones that we've done here in town. And we're talking about going to marketplaces that are much more expensive cost of living. So I think to fully implement this as we're trying to, in a lower cost manner, you're going to have to spend more legislative budget dollars to be able to achieve that. And those are hard decisions, but that is part of what we're trying to be, a comprehensive approach to this in totality.
Thank you, Chris.
Thank you, Eric. You're welcome. We have Karen and then Bill.
So tagging along with the getting the right team together, talk about the collaborative model influence and how that's within the recommended allocation.
Again, Chris Elman, Chief Investment Officer. You know, Karen, it really, as we've talked about within the collaborative model, its main emphasis really does fall in the private asset classes simply because they're so expensive. We can still do it in the public asset classes. The cost trade-off is just smaller. But as we grow real estate and particularly private equity and inflation sensitive, that's a big part of our thought about this new process, new allocations, is that we would seek to do more in the collaborative model, which is, as I've explained many times to people that have questions about it, it's just doing stuff that's different than just limited partnerships, doing other forms of peer group collaborations, syndications, maybe even owning asset managers, finding other ways to get access to these asset classes and get exposure for us on the investment returns we want, but in a higher control and hopefully a more or a lower cost structure. And it will be integrated clearly. This asset allocation really dovetails nicely with where we are planning to go in the collaborative model.
So it will go through all the asset class, be considered through all the asset classes.
Absolutely. You know, we've always historically called it internal management in the public markets areas, but you know, we realized that's actually just another form of collaboration. Do it ourselves instead of just relying on outsiders. And I think we'll continue to look at, it was part of a study, I think it was 2012, of how can we lower our cost overall. First step, internal management. Second step, internalizing some additional strategies. And then the third step is really this collaborative model, which is getting that cost savings in other asset classes.
And then somehow or other, we're going to find that super staff in the meantime.
I think, the answer is yes, I do believe we can. It's always a hit or miss, you know that when we hire people. But our culture is well-known. I think we have a good name, brand reputation in some of our peers, particularly in the West Coast. But it's going to take a different personality. This is a big governmental entity. We have a lot of rules and regulations. So we have tended to be able to recruit people that have a more holistic view of life and want a work-life balance.
Thank you.
And Karen, I did want to clarify one thing, which is that when we're talking about the collaborative model, we didn't incorporate the benefits into the modeling for the asset liability study. The reason is we want to be conservative and make sure that the return streams from the beta from each of the asset classes are true and not incorporating the upside potential of the collaborative model. That being said, it is very related to our funding ratio, right? So if we look out to 2046, when we want to be fully funded, as Chris had stated, I think in May, if we save $200 to $300 million in costs, then over that period, that could translate into something like $19 billion of savings. So it's very much related to the funding ratio, but in the asset liability study, we have not included it because it's more of an investment implementation strategy.
Just one more thing.
Of course.
On the Makita chart on page, I can't remember where it is now. There was a chart that, yes, well, it's INV 22. Yes, it's the pacing. Yeah, it's the pacing. But it also applies to the 13%. There's a big E after those years. I just wanted to know what that stands for.
I'm sorry, that's estimated.
Estimated? Okay. Okay, that's what I thought. Thank you.
Thank you, Karen. Bill?
I want to commend staff for all their work and the consultants as well, because matching up, the asset allocation with the liabilities that we have to foresee going forward, I think you've done a magnificent job. In one area, and Dr. Emkin has reminded me of this before. I'm going to call him doctor because we call on him so often. The fact of the matter is that we in fact can project returns, but those are projections. The one thing we do have some control over are our costs. And I think that, Scott just, addressed that issue, which I think is a very important issue to reinforce here. Because when I go and I look at the cost report, and I see just on, I guess it's INV 58, there's a chart up above which shows externally private managed assets, and I think this is, externally private assets. There's a 67 basis points difference between that which is externally managed and that which is a hybrid private managed. So, I mean, when you just take 2/3 of 1% and apply it, that's a significant number. And so I want to commend staff, and I want to commit as a board member whatever I can do to assist in moving us towards the collaborative model, because I do think that's where we do have some control over our ultimate returns so that we can, in fact, meet our 2046 obligation to be fully funded. So again, thank you for all you've been doing.
Bill. Joy?
Thank you. I think that Bill said it really well. I just want to, add my thanks to all the work that all of our staff and the consultants have done over the last year plus working on this. I've got just one quick question. So if the committee adopts the recommendation today, then I think you'll come back at a future meeting with sort of an implementation plan. We've talked a little bit about what the pacing would look like for some of the change in the private equity or in the real estate and inflation sensitive and RMS allocations. But will there also be sort of an implementation plan developed or reports to the board on how we lower, what approach we take to lower our our public equity, allocation?
Thank you for that question. All of you should have at your table, and there's some in the back of the room, kind of an implementation plan. because as we slowly roll out the privates, we're obviously pulling assets out of the public asset classes. And so this is a tentative plan. It's based on our opportunities and the ability we have to pace. I don't know if everyone sees it. So yes, that's exactly it. We'll have steps. We'll come back in January with the first step, and the others will be tentative again, based on the opportunities and the market. We never like to force assets in. We'll basically invest and then adjust the publics as we need to.
Great. Thank you for, we've got a lot of paper in front of us,
Yeah,
so I hadn't
just
seen
I
this,
found
so
it.
thank you for pointing that out. Then, Mr. Chair, I'd like to make a motion to approve the staff recommendation on this item.
Thank you.
Second.
It's been moved by Ms. Higa, seconded by Ms. Hendricks to approve the staff recommendation for the asset liability study. Betty, would you like to speak to the motion? I don't have you in, for some reason you did not come up in the queue,
Okay.
so we're having some technical difficulties with your button there. Do you want to move over? Is your mic on?
It looks like it is. Yeah, the green light.
So go right
It's
ahead,
on. Okay.
Betty, controller.
Thank you. Again, also adding my thanks to the tremendous work here. And my question really is also related to risk, but it's probably going to be more enlightened with the implementation plan and the pacing all across the allocation. And that is really the risk of executing the new allocation over the next several years and what, I guess, assumptions have been made in the event of a severe market downturn. And I guess I'm really interested in whether there's flexibility built in terms of the ability to even delay selling some of our global equity assets in a down market, and then also any concerns about our real estate returns in the next economic downturn.
And maybe others want to. There absolutely is flexibility, and while we have strategic targets, we do tactical discussions and rebalancing based on the market environment. And all of the asset class directors, particularly real estate is the one you raise, are making decisions all the time about what's best and how to best position themselves. So we won't be forcing anything, and we will be opportunistic.
And then on global equity as well, in terms of the ability to delay any sale of global equity assets in a downturn.
Yes, and I think what you're referring to is if, right at this point, you do get in the CIO report, we give you every board meeting kind of analysis, can we pay our benefits? And the answer is always yes. That being said, right now we are undertaking a project to look at our liquidity and make sure that we can be very opportunistic, pay all of our bills, and reposition appropriately if there's a market drawdown. And we hope to be coming back to you soon with that analysis. And if there's any recommendations on how we'd want to adjust our portfolio, we would have it then.
All right, great, thank you. Yeah.
Thank you. So there was a motion on the floor made by Ms. Higa, seconded by Ms. Hendricks to approve the staff recommendation on the asset liability study. Any further discussion or questions? Seeing none, all those in favor of the staff recommendation, say aye.
Aye.
Opposed? The motion passes unanimously. Thank you very much.
Thank you very
And I want
much.
to commend the staff, the team, the consultants for a job well done.
All year.
Thank you. One point of clarification, the actuaries spent lots of time and energy, and they're in the audience too, so they deserve credit also.
Great, everyone who helped us get here. Thank you.
We'll clap for them Friday when they present, so we'll make sure we give them props on Friday.
Okay. So we also adopted flexibility for the agenda. This is where flexibility will come in. We're going to take comments from members of the public at this time. So when your name is called, would you please approach one of the microphones? And you will be given 3 minutes to speak.
Bye, Dr. Emkin.
Yeah.
See you, Doc.
So our first two speakers are Britt Dowdy and Lita Blank.
See Britt. Okay. There he is.
Mr. Dowdy from the California Federation of Teachers, nice to see you.
Good afternoon. So I'm Britt Dowdy. I'm a teacher in Costa Mesa, a member of CalSTRS, and also here on behalf of the California Federation of Teachers. My comments are related to the reports which the board received in October at the San Diego Service Center related to climate change, as well as to the ALM study which you just approved. And what I want the persons who were not able to go to San Diego to see that excellent presentation is to know that there were a very strong economic indicators that could directly tie into pieces and parts of the allocation. There were recommendations about how there are economic factors related to climate change in real estate, within crop yields, within energy companies, all sectors. And so I know that the STRS board is receiving that information, processing it, because this is your first meeting since receiving that report. Also, there was a report on the governance and policy issues of how you can shape your investment strategies. So knowing that you're changing the allocations of how you're moving into real estate and global equities, and knowing that you're probably working on both of these things simultaneously, what we would ask is that we be careful about putting the cart before the horse. It's probably most important to get those policies and governance issues and knowing what criteria you have for your ESG issues in place first, before we start actually doing the work of changing these investments over the next few years. I'm sure you're going to be speaking to most of these issues throughout the rest of the next couple of days. So, there may be elements of this that come out on the next agenda item or tomorrow or perhaps Friday. So if you're able to just help articulate how these two different projects, how maybe their timelines come together in terms of as you do your work, that would be great. Within CFT, as you well know, we are very active and interested in trying to minimize the effects of climate change. We are very active and interested in educating our public about the dangers of climate change and trying to help us as young people to adults be more effective citizens. So we are willing to be partners with you in this effort. We may be able to move things more quickly than the board may be able to, but we want to recognize the excellent work that the STRS board, the reports they've been receiving. We want to recognize how they're integrated together, and we urge you to move as quickly as you are able in creating the policies to help create positive change for our nation as well as our globe. Thank you.
Lead up.